All right, let's get right into it. Every once in a while, a stock makes a move that's so big, so sudden, you just have to pull up the chart and figure out what's going on. And today, that's exactly what we're doing. We're going to dissect the anatomy of this huge surge in a stock called Vivakor, ticker VIVK, and see what the technicals are really telling us. And it all kicked off with this one number, a jump of nearly 12% in a single day. Now, a move like that, that's going to get anyone who follows the market to stop what they're doing and take notice. But believe me, the price jump, that's only part of the story. Because here's where things get really wild, the volume. Look at that. Over 436 million shares changed hands. Now, to give you some perspective, its average volume over the last 3 months was about 16 million. So this isn't just a little bit of interest, this is a full-blown wildfire of activity. The whole market, it seems, showed up to this party. So all of that action brings us to the million-dollar question, right? Is this massive surge the beginning of a real sustainable breakout, or is it just a flash in the pan, a temporary blip that's going to fizzle out? Let's see what the data has to say.
First things first, let's look at the bull case. Why are people optimistic? Well, there are actually several key technical indicators that are flashing bright green, and they suggest there might be some serious power behind this move.
So let's just break this down. From a short-term perspective, things look pretty good. The price is blasted past its key moving averages. That's a classic sign of strength. We're also seeing some really positive momentum signals, like a MACD crossover and a strong ADX reading, which tells us the trend has some real direction behind it. And as you can see, the price is pushing up into the top half of its Bollinger Bands, with a parabolic SAR right underneath it, both of which are basically cheering on this bullish trend. And for anyone who's not super familiar with this stuff, a MACD crossover is a classic go-to signal for traders. All it means is that the faster moving average is crossing above the slower one, which often suggests that upward momentum is building. It's one of the main pieces of evidence the bulls are hanging their hats on right now. And, the analysis itself really spells this out pretty clearly. Being in the upper half of the Bollinger Bands isn't just a sign of strength. It's a sign of what they call bullish expansion. So what does that mean? Well, it means there could be even more room to run. The price could keep pushing towards that upper band, which is currently sitting around 36 cents. Okay, so that all sounds pretty good, right? But hold on. That is only one side of the coin. For every one of those bullish signals, there's a bearish counterpoint that is painting a very, very different picture. And here it is. This is the heart of the conflict. It's basically a technical tug-of-war. On one side, you have all that awesome short-term momentum we just talked about, but on the other side, the bigger picture is frankly pretty bearish. The stock is still trading way below its long-term 100-day and 200-day moving averages, and that confirms a pretty serious downtrend is still the dominant force here. And if that wasn't enough, you've got a whole bunch of warning lights flashing on the dashboard. Several key gauges are screaming that this rally might be overextended. We're talking about indicators like the Stochastic RSI, the CCI, and the money flow index. They're all hitting extreme highs. When these things get pegged this high, it's often a warning that a stock has gone too far, too fast, and might be due for a cool down. And here's the kicker, the stat that really puts all of this into perspective: even after this massive jump, the stock is trading at less than 3% of its 52-week high. Let that sink in. This isn't just a little dip we're fighting against, it's a major, established, long-term downtrend. So you've got these two armies, the bulls and the bears, staring each other down. The big question is, where is the actual battle line drawn? Well, the technicals give us some very specific price levels that we need to be watching. And the charts give us some very clear lines in the sand. The most critical level to watch on the downside is support at about 22 cents. If the price can stay above that, the bulls have a fighting chance. On the upside, the big ceiling they need to smash through is resistance at around 42 cents. These two numbers are likely going to define the next move for this stock. All right, so we've looked at the good, we've looked at the bad. Let's try to put it all together. What is the final takeaway from all this conflicting information? So the game plan kind of boils down to this. For the bulls, everything, and I mean everything, depends on holding that 22-cent support level. If they can do that and the volume stays high, then that 42-cent resistance is the next logical target. For the bears, a break below 22 cents would be a huge victory, and it would likely send the price tumbling back down. So the suggested strategy here is pretty logical. Short-term traders might want to be careful and maybe lock in some profits, given those overbought signals. But if you're a long-term investor, you probably want to wait for a decisive break above that 42-cent resistance before you even think about calling this a real trend reversal. And that brings us right back to the ultimate question. You've got this explosive short-term momentum, an irresistible force smashing headfirst into a deep-seated long-term downtrend, the immovable object. It's a classic showdown. The charts have laid out the battlefield for us. Now we just have to watch and see which side wins the war for VVK.